Good evening, everybody. It's Sterling here with the daily market review for March 3rd, 2013. We'll start by talking about the pound because really there's not a whole lot to talk about. We go into the 15-minute. You can see that we were treating both pairs last week Friday as though we were in level 3 accumulation. The reason for that was that we really didn't have any directional bias. You look again at the hourly chart, and we were just in a sideways accumulating market from the end of the previous down move. So we didn't have a defined cycle at that point, and that's why again last week Thursday, looking at Friday's price action, we were trading it like we're in level 3 accumulation and therefore having no directional bias, just looking for the manipulation at one of the points listed. We had a really good center line at 51.54, excuse me. And you can see we really never had any response to that with the strong surge to the downside here. Which this, by the way, was actually on news, if I remember correctly. It was on manufacturing PMI, which surprisingly, we'll keep an eye on it in the continuing months. But generally, PMI does not have all that large of a move associated with it, and seeing this type of a deviation here. Now that I'm actually looking at it, we had a not an exceptionally huge deviation from the expected, but nonetheless pretty decent deviation, and therefore we saw some bearish price action and the pound blowing right through those two high probability points, as we mentioned quite a bit. The manipulation not only gets us into trades, but equally as important, if not more important, is that it keeps us out of bad trades. So in situations like this where you just plow through your high probability points, it's a pretty clear no trade situation. So the only potential option here was the stop run of one spot 5,000, and looking at that stop run of one spot 5,000, depending on where you were taking your entry, if you did like it or not, the confirmation came a bit later on, and the trouble with this trade is that from the end of that confirmation, it was about 22, 23 pips away. So even at the depths of that pullback on the third candle. So, and I'll zoom this in so you guys can see what I'm talking about. This candle, essentially right here, was what I was terming as the first candle in the setup. Really, if you look at it, if you're looking for a confirming entry, and you see the market come in, and it's just a little bit about entry before we get into today's direction. But when this first candle comes in, you see it as a stop run candle. You say, okay, that's the first candle in the setup. That's my stop run candle, and therefore the next candle I'll be looking for the confirmation. Well, as these candles continue to occur, and in this case still closing above the one spot 5,000 level, I'm essentially moving what I believe to be is the first candle over until I get some confirmation. So zoom in even closer. So again, I get this another candle that comes down, breaks the one spot 5,000 level. So as soon as that candle closes, I'm waiting for the next candle to show me the confirmation of the upside. Doesn't happen. Next candle closes. Again, waiting for the next candle to show me the confirmation, and in fact it does. And that's where, after you had that setup, you essentially have your confirmation candle here, and this was your third candle for the pullback. Now in this situation, I still want to get my stop below this, essentially the stop run low, and from those lows, if you were taking it at 06, therefore you probably would have had an entry around 08. If you're going along on that setup, factoring in the spread. So if you're long from 08, then your stop has to be 88. And the lows here are 84, 85. You figure you got to get a couple pips below that. So it would have taken a 26, 27 pip stop. You just didn't have enough pullback for that entry. Now, for those that are a bit more aggressive and you were taking it after the original stop run candle and taking it on a 50% pullback on a stop run candle, well, you had an entry there, but for me, that's a no trade situation just because of the fact that we didn't have the pullback there. So really a big kind of at least from the high probability points, we listed a no trade situation on the pound, and one opportunity a little bit later during the New York session for a potential New York reversal trade. So we go over to the euro, and in the euro we had quite a few levels on. Remember the euro, which is quite rare. We had 3 levels to both sides. The upper levels were out of really question, just because of the fact that we only came into the first point. So your 2 outer levels that I did like a bit better were out of the question. This for me would have been a no trade. I'll tell you why. There's a, you know, if you're, I'm speaking strictly to the fact of a stop run of 3100. There was definitely reason to believe that there was some manipulation. There was a break above these previous highs at 93 and break above the Asian highs. The candles were perfect there. I'm talking strictly from a break of 3100. There was a question I had in an email in regards to that, and it was essentially saying how far of a break do we need to see of a level to consider it a stop run. Well, in general, you don't want to see a half pip break, which is exactly what we saw here. You want to see a 3, 4, 5 pip break, and nowadays that's pretty reasonable, just because we're seeing volatility increasing. So looking at it from the perspective of where I want new traders to be, which is following what I say in the daily market review very closely, as somebody progresses and they begin to understand, okay, the number one, factoring in clarity of a setup. Is there reason to believe that we could be seeing stops taken out a bit lower? And in this example, I think that was really the main driving force behind those that were taking it. You did have a stop above the 93 level, above the Asian highs, and if you look at that candle formation, it doesn't really get much better than that, and especially with your third candle pullback. So you had a lot of reason to believe in that trade. Strictly from the 3100 standpoint, I wouldn't necessarily have called it a stop run. We did have some lower levels here, but again, the 3100 was the point if you're looking from a stop run from that perspective. In my opinion, didn't quite show it. To the downside, again, it's fairly simple and straightforward when we're looking at the euro here. So you came into your first point, and we blew right through that first point, and then the second level, this 3038 level, we'll go back, we'll look at our charts. You can see we had a decent response through there, and then that's where I was getting the overall lows from, which is that one spot 3020 level. Now, in this trade example, depending on, and I know that we did at least have one taking this, so I did want to cover it as well. But going into this trade setup, and me not watching it, I don't like to say one way or the other whether I would have taken it or I wouldn't have. I can generally speak to something if it's clear, and I don't mind, I don't mind talking about if it's clear and obvious. In this situation where we have essentially the market opening again and closing below a certain point, that's what should start to get you a little bit wary of that situation. Number one, it's not that the first candle closed through it, because in an example of a set of reversal legs, what do you have? You have the first candle closing through a level, the next level getting rejected back out of it. In this circumstance, because we had 2 candles now closing below that point, it does start to make me question it one way or the other. Again, I'm not a trade that I was taking, but even in this situation, if you took the entry, would have had to have been pretty well a great entry, unless you're taking on the fourth candle with a little bit deeper pullback. So some food for thought on that one. I mean, it was questionable, and one of the things that I always say in a questionable situation, you guys have probably heard me say this 1,000 times, if something is outside of the normal, we avoid it. That's a pretty simple standard rule that we apply. In this situation where you see the first candle close below it, then you see the second candle close below it, it should start to raise some questions. You should start to say, okay, hey, is this going to be the high probability point? Is it the best of the best type setup that I could be looking for? So just some food for thought there. And in general, I won't necessarily say that there couldn't have been a setup there. I'm just going to say that at least from my perspective, looking at that, once we have multiple closes below a point, typically that's why in the case of seeing a morning star and evening star candle pattern, you're seeing that specific type setup. When you have 2 bearish strong closes like this, not quite the similar setup, and again, that's why I'm not 100% comfortable with it. But if you did take it, I wouldn't necessarily call it a bad trade. I would just give some of what I said some food for thought. And it always pays, in my opinion, to be selective. The more selective you are, the higher chance you have of avoiding stuff that looks lackluster. Now, developing that patience, that skill to wait for really clear candle formations is something that it's not the natural reaction, in my opinion. You see the market moving, you want to be in on it, but from what we do, we take a very zoomed out approach, if you will, and we look at only the high probability points, and we say to ourselves, okay, once the market has gotten to this level, is it very clearly showing me that stops were taken below that point and quickly rejected back up above that level? In the case of a long, and obviously in the case of a short, rejected back down below it. And that's really the question that we're answering. That's where some analysis of candle comes in. Is that strong rejection, or is it just a lackluster rejection? Are we getting enough of a pullback to warrant taking a 20 pip stop? Are we within the area of where a 20 pip stop would be applicable? So just a few thoughts to go over, which did apply to that trade specifically. So going into the third point, the 1 spot 30-20 level, again with about a half a pip break, not necessarily enough break to warrant taking a trade from that, and thus really why, in my opinion, past the initial setup of the long and more of a forced setup here, I didn't really see anything beyond that point. What's nice about last Friday's price actions, I believe we did have a little more probability baked into essentially the current cycle that we're in right now, or there is a higher probability, in my opinion. Last week we really didn't have a whole lot of confidence in the fact that this was a first push to the downside. It could have. We talked about this a bit last week, but in the sense that this was the first false push to the upside, there was a possibility that this was the true first push to the downside. But because we had stayed in that level 3 accumulation for so long, because we had just been chopping back and forth, what I had decided to do on Friday was to trade it without that directional bias, and that opened up the direction depending on where we're seeing the manipulation. So when it did follow through to the downside, that kind of confirms for me that this was the first push, and makes me believe that we've seen now the second push to the downside. So if we've seen that second push to the downside, then we should be expecting the third push to the downside. So let's zoom in and we'll talk about our high probability points here. So looking at the euro, it's pretty straightforward. The level that I like comes in right about here. Let me go back and get a line. This was a point that we had used last time as well, which was 38. So we'll leave 38 in there, and you can see how 38 coincides with this level here. Also, by the time the 200 EMA gets there, more than likely, or by the time the price gets there, more than likely the 200 EMA will be there as well. So I do like the 38 level. That's a nice point to look for the manipulation from. Might be a bit higher. Might actually, let's call that 41. That's a little more recent, and I'm gonna put a little more bias on the last test that we had. So it could be that they just take stops above the Asian high. But one thing that I know is that whenever I have two price points that are close together, it's always safer in the case of in the case of a short setup. It's always safer to go for the higher level, because one thing that you don't know is if they've shown you the stopper on the first point, is it cost effective for them to go get stops at the second level? That's one thing you don't know in the moment. So the safer option, again, if you take the deeper level, one thing you know is they've already taken the stops below it, and taking that deeper level, you're just taking the little bit safer option. Does mean you may miss it if they go off the shallower level, but it's not about quantity of trades, it's about the quality of the trades that we're taking. So we're not going to really worry about that too much. We'll play it safe and go off that point. So 1 point for me today, it's possible that they come up in this deeper level of 53, 54, which is a point that we did use as well last week. So that level is possible, and I would keep that in mind if we do go a bit deeper. But I think 40 is the best option. I will list both, however, though. Okay, so going into the pound's pretty straightforward. Again, we were treating the pound like we were in standard level 3 accumulation, just back and forth, back and forth. So all through here, we really didn't have much of a directional bias, but we've had a clear push out of that accumulation. And thus why, as you guys probably assumed, I'm calling this the first push down and the start of the fresh cycle to the downside. If that's the first push, then we should be looking for the second. And the point I'm going to use to the upside is pretty obvious, and we go back, you can see why. It's the 50-80 level. That's a great point. You have right in the center of your typical manipulation area. The 200 EMA is right there. Very, very clear, fresh low. So one of the things that I would keep in mind is the current Asian highs as well. I'm not going to go off any deeper levels because if this level's pierced and we go above that, I think it falls right back into that accumulation. So if we break back into the range and close in the range, well then you guys know how we're going to be trading it the following day. But there's really 2 points that I would look for. One is the 80 level, which is a great point, but we're kind of hovering right around the Asian highs right now. Heck of a lot of response there. No doubt there's short-term orders above that point. What I would like to see, which would confirm all the stops would more than likely be converged above that point, is if we start to break out to the downside first. If we break out to the downside first, that's going to bring everybody's stops down right above this point, and that's when I'd love to see them come back up, take out the stops at that 43 level. If we stay sideways right here at the beginning of the European session, I trust it much less. So I'd like to see the move down first, if we're going to use the one spot 50-43 level as a potential manipulation point for the second push to the downside on the pound. One last thing I want to say about the euro. When you look at cycle, again, we didn't have much of a bias last week, Friday, because there just wasn't anything there. We're sitting within level 3 accumulation, and that was the safe bet. So last week, yes, it was possible that was the first push down, which would obviously be in line with the price action that we saw on Friday, but we just didn't know. And so by seeing Friday's price action, then that more or less gives us much stronger confirmation for that direction. And that also rules out, for me at least, for anything other than in New York reversal trade, if we do not see, or if we did see a long setup off what you believe to be a high probability point to the low side, that would be a trade that I would miss, because we have that section, we have the overall cycle bias a bit stronger because of last Friday's move. So we start to also ask ourselves, really, if you're looking at a current day, you look back within a 3 to 4 day period, within the last 3 or 4 days, what is the most viable option for the cycle that we're in? And at this point, the highest probability is that, let me get rid of this, is that this ended up being the failed first push to the upside, and now we have a first push down, second push down, expecting the third. So that's where we're going to trade it, and we will see what happens. As always, the manipulation is the guide. Should the market just blow right through those points, well, then that's what happens, and more than likely that would result in a no-trade situation. But manipulation, again, not only gets us into trades, but also keeps us out when it's not going to see a response. So hopefully we'll see that response. We'll wait for the candles, be patient, make sure we have a clear setup, and if applicable, feel free to jump on it. So we'll see what type of price action we get. Hopefully have some more nice setups here. Anyways, glad to be back, guys. I hope everybody had a great weekend. Look forward to seeing everybody new in the room this week. And I'll see you guys Tuesday. Otherwise, I will see you tomorrow for the next daily market review. Till then, happy trading.